Have you ever wondered if investing into the stock market is really such a sure win and easy endeavor, with inverted commas of course? Why do we not have a lot more successful investors coming out to share their stories and experiences about long-term, prudent investment strategies? On the reverse, we've probably all had that one uncle who always complains during the yearly family gathering about how the stock market is a sham, he had lost his underwear in the previous crisis, and investing is not a viable wealth building strategy. At the same time, you have probably come across data and statistics about how stocks have been one of the greatest compounders of wealth over the last century. Not just the last 1 year or 10 years, it's for the last century, 100 freaking years. Yet, you have heard multiple accounts of how people still manage to lose incredible amounts of money in a market that seemingly just goes up in the long term. In fact, you even have studies and data sets collected by JP Morgan outlining how the average investor is consistently underperforming the market, regardless of the benchmark that you look at. So here's the million-dollar question. Why are we always wrong about the stock market? So to answer this question, I'll quote from Howard Marks's recent memo, Mr. Market Miscalculates. First off, who is Mr. Market? Benjamin Graham, who was Warren Buffett's teacher, introduced this metaphorical person in his book, The Intelligent Investor. So imagine that you own a small share of a private business today that cost you, let's say, $1,000. So one of your partners, named Mr. Market, is very obliging. Every day, he tells you what he thinks your interest is worth, and furthermore, offers either to buy your share out or to sell you an additional interest on that basis. Sometimes, his idea of the valuation appears remotely plausible and justified by the business developments and prospects. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away from him, and the value he proposes seems to you a little short of silly. Of course, the intended Mr. Market metaphor here represents the stock market as a whole. Every day, when the market is open, you can log in to your brokerage account and you are fed with a whole list of different prices that Mr. Market is throwing at you. So given this inconsistent behavior, the price he assigns to the stocks each day can diverge, sometimes wildly from their fair value. Sometimes I also wonder, why are you not consistently smashing the like button? Let's not be Mr. Market and let's bring this channel to an all-time high. Now, back to the video. So do you remember just 2 years ago, Meta Platforms, the company that was formerly known as Facebook, saw its share price in a roller coaster ride in a short span of 3 years. In 2021, they were at a peak of $380 per share, and it dropped by more than 75% in a span of around a year. Today, they're hovering right around their all-time highs at above $500 a pop. So the sheer volume of stocks exchanging hands and where the share price is going the next day is really just crazy and insane. So you cannot argue that the true value of Meta underwent such a significant transformation, falling by 75% and then recovering by more than 5x from its lows in just 1.5 years. So what exactly is going on? So going back to the Mr. Market analogy, when he's over-enthusiastic, you can sell to him at prices that are intrinsically too high. And when he's overly fearful, you can buy from him at prices that are fundamentally too low. And here's what Howard Marks, the co-founder of Oaktree Capital and also a billionaire investor, has to say about this large disparity and pendulum swings that takes into effect in the economy and by extension, the stock market.
Lately, people have been asking me, what is the biggest mistake that you've seen, or what is the mistake that people make most often? And I think it is that once the market is moving in one direction, that it will always continue to do so. In truth, regression toward the mean or the correction of excesses is much more dependable than continued movement in a straight line.
Why do things revert back?
Because I wrote a book in 2018 called Mastering the Market Cycle. And I'm a great believer in cycles. I'm a student of cycles. I've lived with cycles for a long time. And yet, when I got about 2/3 of the way through writing the book, I said to myself, why do we have cycles? The economy grows at 2% a year. Why doesn't it just grow 2% every year? Why sometimes 1 and sometimes 3 and sometimes -1?
What's the answer?
The answer is that people go to excess. And for example, if the economy is growing well for a few years, business heads say, oh, well, we have to build a new factory to get our increased share of the growth in our industry. And so they do, but so does everybody else. Now there are too many factories, and now the factory utilization falls and the companies go into decline. So then they pull back and they stop building factories.
So straightforward greed and fear.
Greed and fear is a good way to put it. And you mentioned the memos. The second memo I wrote, 1991, was called The Pendulum. Greed and fear, optimism and pessimism, credulousness and skepticism.
So the natural question would then be, what's the problem here? If, assuming all of us as market participants play our role as rational and effective stakeholders, then we'll have better investment results? In theory, maybe. But here's the problem. I think most of us cannot resist the temptation to do something with our portfolio, especially when there is huge volatility. The human brain is hardwired to work against you, especially in an auction-based environment like the stock market. Let me give you an example. So do you have people around you telling you, oh man, the market is at all-time highs right now. How I wish it could be 10 or even 20% cheaper from here. If it does drop, I'll definitely be a buyer at those price points. So does this commentary sound familiar? But here's the interesting thing. It's usually the same group of investors who missed the previous pullback, correction, or even bear market when stocks were trading at much cheaper valuations. So if you were to allow me to paraphrase them, they are not saying that they want stocks to be 20% cheaper from here. What they want is the sentiments around the market to be exactly the same as the present moment. Yet, they're able to pick up stocks at a discount immediately, realizing that profit. But if you to think about it logically, this is counterintuitive. In order for you to buy a stock or even an index ETF at a cheaper price compared to today, there has to be a change in either expectations or even consensus, especially in larger drawdowns like a bear market. So do you still remember what the sentiments were in 2022? What happened in the US markets? So as a result of the pandemic, soaring inflation, and rapid interest rate increases, sentiments hit a rock bottom as investors were depressed by the universally negative outlook. So we had inflation, and that's probably bad. And we increased the rates to fight it, and that's probably sure to bring on a recession. And that's also bad. So everything that you consume online seems to be pointing towards a downturn. And who in the right mind would be pouring more money into the stock market as companies are expected to take a hit from this slowdown? So that same group of investors that said that they wanted to buy stocks at a cheaper price in 2021, I'm not too sure if they've managed to take advantage of the 2022 bear market. Because there's always a sound and logical enough explanation to stay out of the market. But we'll just like to remind everyone that the stock market always climbs on a wall of worry, and there will always be a convincing argument to stay on the sidelines. And whether this train of thought helps you build wealth over the long term is a whole different discussion. So you have volatile psychology, skewed perception, overreaction, cognitive dissonance, rapid-fire contagion, irrationality, wishful thinking, forgetfulness, and a lack of dependable principles. Together, they are cardinal sins of investing and are responsible for the extreme market highs and lows. And as the saying goes, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. So the next question would then be, what do we do from here? How do we become better investors and outsmart the market? So going back to Howard Marks, here's what he has to say.
So how important is it to be contrarian in finance?
Well, I think it's essential. Contrarianism merely means betting against the consensus.
Yeah.
On every subject, there's a consensus. There's what most people believe is the case. When the consensus is too strong and there's too much optimism that the consensus outcome will apply, maybe the odds for betting on the improbable outcome are so high that it's a compelling bet. The consensus, if you take that into the investment markets, the knowledge consensus is already embodied in the price of every asset. Maybe you can find times when you think the consensus is wrong, and you can do better by betting against it. Usually because the payoff is so high for doing the thing that is considered unlikely. Now, I want to stress that I don't think it's a good idea to routinely say, well, what does the consensus think? Let's do the opposite. The process has to be much deeper than that. You have to say, what does the consensus think? What do I think? What's wrong with the consensus thinking? Why did they think that way? What could make the error of their ways exposed? So it's a very deep question, but you don't usually make much money by betting on the thing that everybody else loves. The big money is made by betting on the things they hate, which as a result are cheap, if you're right.
I think the advice of needing to be a contrarian is a sound one, but a tough one to execute. Not everyone has the ability to go against human nature and, for the lack of a better word, be a loner and exist outside the mainstream. So if I may offer a different perspective, being contrarian is tough, but it's a necessary evil. The bigger underlying issue that we are trying to solve is how do we come up with a process that keeps our emotions at bay while staying vested in the market, especially in market downturns. So I don't have the best way or even the correct answer per se, but here are a few things that I'm doing. First, try as much as possible to automate the investing process. Machines aren't swayed by emotions. So using tools like a regular savings plan, automatic deduction through a DCA approach, or even setting up good deal cancelled orders can help keep your emotions in check. The more you can remove yourself from the decision-making process, the better, unless you're actively managing your own investments. Second, surround yourself with high-quality investors who will hold you accountable. It's crucial to have a community that keeps you grounded, especially during tough market conditions. So having people around you who challenges your thinking will help you stay rational. Third, delay any discretionary decisions for as long as you can. Personally, I give myself a minimum of 2 days. After sitting with the decision for at least 48 hours, I think that my thoughts would have crystallized and any emotional reaction would probably have settled. So this pause helps you make more rational and well thought out moves. So do you have any other tips for fellow investors on how to manage emotions and stay disciplined? Share them in the comments below. And if you're looking for more investing resources, make sure to check out the links in the description. So this is CK from Piranha Profit signing off. Till next time, keep winning.